Hello everyone, this is Therese Fitzgerald, Senior Editor of Commercial Property Executive and our sister site, Multi-Housing News. In today's podcast, I'm talking about opportunity zones, something that is on everyone's mind. These zones, there are 8,700 of them in the United States, were created by the new tax law, and it's estimated they will stimulate $100 billion in private investments. Numerous funds are being raised right now, and a few investors, including some big names like Goldman Sachs and Prudential Financial, have already staked their claims in these zones. The general idea is for investors in real estate and other asset classes to be able to reinvest their unrealized capital gains in these underperforming districts, which will benefit by receiving new housing, more jobs, and stronger economies overall. The program targets neighborhoods that have been largely overlooked by real estate capital during the current upcycle and previous upcycles. Obviously, we are going to be covering opportunity zones a lot over the next couple of years, but I thought we would start today with the basics. What is this program exactly? What are the precise tax benefits of investing in it? How do you as a real estate investor get involved? And what are the rules you need to follow? To help us discuss these topics, we are joined today by Stephen Bokiess, a partner at accounting, tax, and business consulting firm Friedman LLP, and the leader of Friedman's new Qualified Opportunity Zone consulting practice. Welcome, Stephen, and thank you for being here.
Thank you.
Stephen, opportunity zones are definitely something that the real estate industry is excited and curious about. Can you briefly review for our readers what opportunity zones are?
Sure, Therese. The concept of opportunity zones were created by the new tax law that passed in December of 2017. It's a very complicated piece of legislation requiring a lot of analysis and interpretation, and there's still many unanswered questions as we await additional guidance from the IRS. Effectively, opportunity zones are designated low-income communities, and these designations were made by the states last April. There are over 8,700 certified opportunity zones in all 50 states, Washington, D.C., and even Puerto Rico and the Virgin Islands. In fact, about 10 to 12% of the entire United States is in an opportunity zone. These initial Opportunity Zone Fund designations remain in effect for 10 years until December 31st, 2028, and at that point, the designations are revised. The designation is really intended to incentivize the movement of capital into these areas to develop property and create and expand businesses to reduce poverty and increase employment. And the deployment of capital is done through investments in opportunity zone funds. The funds then invest the capital in the zones themselves.
And what are the tax benefits of investing in opportunity zone funds?
The tax benefits are two-pronged. First, there's the temporary deferral of capital gain recognition for invested capital gains. So, for example, let's assume that I sell stock at a gain of $1 million. I can, under normal tax law, that $1 million would be taxable in 2019 if I sold the stock in 2019. If I invest that $1 million gain into a Qualified Opportunity Zone Fund, in other words, if I take $1 million of cash and invest it in the fund, that $1 million does not become taxable until December 31st, 2026. So effectively, I have a 7-year deferral on paying the capital gains tax. The second part of the tax benefit is that if I hold on to my investment in the Qualified Opportunity Zone Fund itself for at least 10 years, any gain on the sale of that fund is excluded. So if I invest $1 million into a Qualified Opportunity Zone Fund, all attributable to deferred capital gains, and say 15 years from now I sell that investment for $1.7 million, that entire $700,000 gain is excluded from taxable income. So to give a little more detail, from the time of a taxpayer realizing a capital gain, the taxpayers have 180 days to invest the cash up to the amount of the realized gains into the Opportunity Zone Fund. These gains, again, are not taxable until December 31st, 2026. And there's an additional benefit. If the investment in the fund is held for at least 5 years, 10% of those deferred gains are eliminated. If the investment in the fund is held for at least 7 years, 15% of those deferred gains are eliminated, and only 85% of the deferred gain would be taxable in 2026. So effectively, the invested capital gains are deferred until 2026, and then if the investment in the fund is held for at least 10 years, Any appreciation on the investment in the fund escapes taxation altogether. So it's really a two-pronged benefit.
Who or what entities can defer gains?
The entities that can defer gains are very broad. Individuals, C corporations, including RICs, which are mutual funds and REITs, partnerships, S corporations, trusts, and estates. All of those can defer gains and invest in qualified opportunity zone funds.
And what if I wanted to invest more than my deferred gains?
The tax benefits only are applicable to deferred capital gains. It's possible to invest beyond deferred capital gains, but there are no benefits other than an ordinary investment in a partnership or a corp. So to give an example, if I sell stock for $1.5 million and I realize a capital gain of $500,000, but I invest the full $1.5 million, and obviously the $500,000 of capital gains would be deferred. If 10 years, 12 years down the line, I sell my investment at a gain of $3 million, because my initial investment was only comprised of a third, $500,000 of the $1.5 million being deferred capital gains, only a third of the gain on this ultimate disposition of the fund would escape taxation. So in my example, there's a $3 million gain. $1 million of the capital gain would be excluded. The other 2/3, the $2 million, would be taxable.
How would I go about forming one of these funds or finding one to invest in?
An Opportunity Zone fund has to be either a partnership or a corporation, including S corps. The entity elects to be a Qualified Opportunity Fund by attaching a form with its tax return for the year that it wants the QOF election to apply. There's no specific approval process or vetting process. The organizing documents of the Qualified Opportunity Fund have to state the intent that this is a Qualified Opportunity Fund and to describe the business or businesses that the fund expects to engage in. There's an asset test. At least 90% of the assets have to be Qualified Opportunity Zone property. So what is Qualified Opportunity Zone property? It's Qualified Opportunity Zone business property, which we'll elaborate upon, investments in Qualified Opportunity Zone stock, and investments in Qualified Opportunity Zone partnership interests.
What is Qualified Opportunity Zone business property?
Qualified Opportunity Zone business property has to meet certain requirements. It's tangible property used in a trade or business, and it has to be acquired after December 31st, 2017. A lot of investors have called me and said, well, you know what, I have a building in an Opportunity Zone, and my first question is, did you own that prior to December 31st, 2017? If the answer is yes, it doesn't matter that it's in the zone. It's not qualifying property. So the property, first and foremost, has to be acquired by purchase after December 31st, 2017. If the property is brand new, you're fine. If the property is used, for example, let's assume that you buy a building that was existing, then the building has to be substantially improved. And what does that mean? It means that within 30 months, the investment in the building has to be doubled. So if I purchase a building for $1 million, I would allocate 20% to land. The remaining $800,000 would have to be doubled within 30 months. So the building effectively would have to be renovated. Someone may ask, what's the purpose of that? The purpose is to draw new capital into the Opportunity Zone. If investor A owns the building and sells it to my fund, and I just continue to rent it, it isn't really doing anything for the Qualified Opportunity Zone. If I buy the building and renovate it completely, that's actually improving the Opportunity Zone, improving the residential or commercial posture.
What is a Qualified Opportunity Zone business?
A Qualified Opportunity Zone business is an investment in a domestic corporation or partnership that's acquired for cash after December 31st, 2017 at original issuance. And those businesses have to meet certain requirements. 70% of the tangible property has to be owned or leased that's owned or leased by the entity has to be Qualified Opportunity Zone business property, which we discussed previously, either original use or substantially improved. At least 50% of the entity's total gross income has to be derived from the active conduct of a business in the zone. We're still waiting for guidance on what that means. If the investment is rental real estate, well, clearly the rents are generated in the zone. If the business is a restaurant, you're clearly selling food in the zone. What if it's a retail store and you're selling things online? Does that constitute generating gross income within the zone? The intent of the legislation is that people are employed in the zone, working in the zone, generating income in the zone. So we're waiting for guidance on that. A substantial portion of the intangible property has to be used in the zone. And less than 5% of the assets of the Qualified Opportunity Zone business can be cash. However, there's an exception. People have said, well, if I have to substantially improve my used property, I need to be sitting on a lot of cash. That's okay as long as there's a written plan to deploy that cash within 31 months. And there are certain businesses that a Qualified Opportunity Zone fund is precluded from investing in, which are a private or commercial golf course, a country club, a massage parlor, a hot tub facility, a racetrack, a gambling establishment, or a liquor store.
What are the different ways that real estate investors can invest their gains?
The Opportunity Zone Fund investment has to be in cash. So the investment can't be made in kind, and obviously an investor has to have capital gains that can be thrown in. So that's the first step in order to get the benefits of investing in the zone. Now, there's a 10-year holding requirement because the only way to exclude the gain from the sale of the fund is for this to be a long-term 10-year hold. So a developer wouldn't be a good candidate because a developer would develop real estate and then immediately flip it. Well, you're going to be under 10 years. That's not going to work. Active businesses, the legislation promotes active businesses other than the taboo businesses that we discussed. Rental real estate, there's no guidance on. The prevailing wisdom is that's fine as long as it's a multiple unit building. Still waiting on guidance on exactly what that means. But the intent of the legislation is to improve residential housing in these zones, so it's very unlikely that rental real estate wouldn't qualify. In fact, I'm pretty confident that it will.
Has your new practice helped clients form any of these entities yet?
My firm is getting calls. The phone is ringing off the hook with people interested in doing these. Some are holding back until there's additional guidance. We have professionals with backgrounds in various areas, from legal, heavy real estate expertise, tax expertise, and fund expertise, which we can deploy. I've had clients that have formed the funds and are now in the process of realizing capital gains to invest in the funds, defer them, and then to purchase property. Most of the interest seems to be in real estate, either buying land and developing it, or buying an existing building, renovating it because you have to renovate it, and then rent it. Again, it has to be a 10-year hold for this to work.
What are the common misconceptions about opportunity zones?
There's an issue that the law has to clarify, that the IRS has to clarify, and the IRS has indicated that they're aware of it. The way the law is written, in order to exclude the gain from the sale in the fund obviously has to be held for 10 years, but the sale has to be of the investor's interest in the fund. So if I'm an investor in these partnerships and I've held it for 12 years and I want to sell it, I have to sell my interest in the partnership to exclude the gain. The guidance is silent on what happens if the fund itself sells the property. If this is a partnership, under normal law, if the fund sells a property at a gain, that gain would flow up to the investors and be taxable to them. Well, that would defeat the entire purpose of being in an Opportunity Zone fund. So we're waiting for additional guidance on that. Guidance also is needed on what if an Opportunity Zone fund invests in a building, 6 years down the line, sells it at a gain, and then immediately buys another property in the same zone or a different zone. What happens then? If you realize that gain, that defeats the purpose, one of the major tax benefits of being in the fund. Additional guidance is needed on that.
What are the hidden challenges or risks of Opportunity Zone funds?
As with anything, you don't always want the tax tail to wag the dog. Obviously, there are a lot of tax benefits with investing in these zones, but it has to make sense from a business perspective. There's no point in deferring tax if the investment doesn't do well or it declines in value. In regards to the invested capital gains, the invested capital gains are invested in the fund and deferred. In 2026, those gains become taxable, but the cash is in the fund. So an investor would need access to cash from other sources to pay the tax, because they can't pull that cash out of the fund. To achieve the full tax benefits, this is a 10-year hold. This is not meant to be a short-term investment. So the only way to exclude your gain is to hold this fund for at least 10 years. If you sell the fund in 8 years and you have a huge gain, it's taxable. You hold it for 10 years or more, that taxable gain is excluded.
What types of gains qualified to be deferred?
When the legislation first passed, it was thought that capital gains and ordinary gains could be deferred. The proposed regs made it very clear that only capital gains can be deferred. Therefore, a good candidate for this is stock market gains. So somebody sitting on a ton of stock market gains, this is a good time, if it makes sense, to sell, realize those gains, and defer them by investing in the zone. Somebody sitting on art, somebody sitting on other types of personal property that are sold and generate capital gains. Foreign currency, when you sell foreign currency, that's typically an ordinary gain that wouldn't qualify. So the gain has to be a capital gain.
What parameters did the federal government give the states for choosing which communities would qualify as opportunity zones?
I believe the states were allowed to choose up to 25% of their low-income communities as qualified opportunity zones. So the states basically had to choose the low-income communities that they thought had the best chance of being revitalized with additional investment. So the states have a lot at stake in this.
President Trump recently signed an executive order to create an Opportunity Zone Council that will oversee implementation of the program and encourage private investment in these areas. What impact do you think that will have?
I think that's only going to have a positive impact. Based on the intent of the council, it's been charged with helping with grant funding, loan guarantees, infrastructure spending, and other federal incentives. That can only be positive for these opportunity zones. The council is going to consider legislative proposals and regulatory reform to remove any barriers to these revitalization efforts. So I think the council is going to help facilitate investment in these zones.
What should real estate executives watch out for on the regulatory front?
It's in the interest of both the federal government and the states for this program to be successful. The federal government passed the Opportunity Zone Fund law, and the states were able to choose the zones within each state. It's areas that the states have an interest in revitalizing. So the guidance so far has been very taxpayer friendly, and I would expect further guidance to additionally be taxpayer friendly. There's some unanswered questions. What happens if the fund sells property? We don't want that gain to be tripped. Does rental real estate qualify? Well, we think it does. I think that future regulatory guidance is going to continue to be very favorable because it's in everyone's interest, both federally and at the state local level, for these things to be successful.
Stephen, thank you so much for being here. This was great.
Thank you.
So as I mentioned before, this is a topic CPE and MHM will be watching closely. What the IRS issued in October were actually proposed regulations, so we can expect some changes in the final version. But it is clear that this program will have a significant impact on many communities and bring additional capital into the real estate business, particularly for development projects. The real estate professionals who will benefit the most, however, are those who have the knowledge and experience to navigate the risks that come with investing in these zones. Thank you for listening. Bye for now.